Fair value gaps are the easiest IST concepts to understand, but the hardest to master. Understanding fair value gaps will skyrocket your win rate and get faked out less. In this video, I will guide you from A to Z how to master fair value gaps. To do this, we will go over 5 pillars that will build your foundation to mastery. In these pillars, first I will discuss the biggest mistakes trading fair value gaps. Then I will walk you through how to spot high probability fair value gaps using time and price, liquidity, and inducement. And after that, we'll go full circle by combining all of this with market maker models. Just like a house, you can use these pillars to build off from with other IST concepts like order blocks and market structure. So let's get into it. One of the biggest mistakes traders make while using fair value gaps is they don't know the difference between expansion and consolidation. An expansion is when price is trending. So we trade into a key level and then we start expanding higher highs, higher lows, trading structure. But when we are in a consolidation, fair value gaps, like the one that's created here, see fair value gaps will be created like this, and we trade higher from them and more fair value gaps. In a consolidation, you won't have that. So price trades lower, creates a fair value gap lower, price comes into it, and you expect price to just go lower, but we don't. We trade higher. Then we trade higher, we create another fair value gap, so you expect price to come back into there to then go higher. Doesn't happen in a consolidation. Keep in mind the profile you are currently trading. I rarely trade consolidations because of this. I don't like to be stuck inside my fair value gaps. I want the fair value gaps to hold and then be respected towards the drawn liquidity. And you can use fair value gaps in 2 ways. You can use it as a place to trade from. So price comes back to the fair value gap and you trade from it to the drawn liquidity. But also you can trade towards them. So you get a high here, a lower time to create structure, and you can just trade towards that fair value gap as a target. And let's look at a few examples to demonstrate this. So here you look at a classic consolidation profile, and I want you to follow the fair value gaps. So right here we expand higher. So what you want to see with that expand high, we tap into it and then we just making higher lows. But we're in a consolidation profile, so it doesn't happen. So you're stuck here. So you wait for another fair value gap right here. Bullish fair value gap. So you want to tap into it and then go higher. It doesn't happen. Same when we go bearish. Oh, now we're going bearish fair value gaps, fair value gap 1, fair value gap 2. So we're like, okay, now we are good. Tap into it, boom, nope, back into the range. So this is why you should avoid trading consolidations while using fair value gap. What you want to do is use fair value gaps in an expansion profile. So right here, we take a low and then start displacing higher, leaving a fair value gap here, fair value gap here. And here we use it as a place to trade from. Price comes to the fair value gap, you can enter here, expands higher. What is now created? Another fair value gap. Come into it, trades higher. Next to using a fair value gap as a place to trade from, you can also trade towards that. So this fair value gap is still left open. So once we start making bearish structure, this could be a very nice target. So right here, what we do is we take a high, we start displacing lower, we use a fair value gap as a place to trade from here, then we trade lower, creating another fair value gap. And what's our target to trade from? And trade towards. So you're trading towards the fair value gap here. And let's talk about the first pillar. And the first pillar we're going to discuss is very important in IST trading. It's combining time with price. So the first pillar is going to be fair value gaps together with kill zones. Fair value gaps created inside kill zones are high probability, especially inside the silver bullet windows. Silver bullet windows in London session is on 3 to 4 a.m. EST. It's on New York time. New York AM session is 10 to 11, PM is 2 to 3 PM. So aim for the kill zones and even better bonus points if you can do it inside the silver bullet windows. So here we look at an example of the London kill zone, and there's an indicator. It's called IST kill zone and pivots. I will draw it now on the screen. If you zoom out here, blue is the Asian session, this is the London session. It's very easy to spot the kill zone. I'll leave the settings here on the screen so you can pause the video now and maybe take a screenshot. And what you see here is on the higher time frame here on Euro US dollar, we are quite bullish and we have a clear drawn liquidity. That's the high here. So we want to trade higher, we have a bullish bias, and look at what we do right here. So between 3 and 4, the London silver bullet inside the London kill zone, we create a fair value gap, tap into it, start displacing higher, leaving another fair value gap, and price just starts trading up and up and up. Same for the New York kill zone. Here we have a CPI data, big red candle, big black candle, down candle to the downside, but we are still bullish here. So it's going to be manipulation, and we start creating fair value gaps to the upside. And remember, fair value gaps in a kill zone are bonus points. Fair value gap right here. Start expanding higher again, and this is a fair value gap created in a silver bullet between 10 and 11. Create this fair value gap and respect it to then go up. We create another fair value gap right here, that's respected, and we start trading upwards. As next pillar, we're going to dive to the core of how to identify high probability fair value gap. It's a fair value gap that is created after hitting a PD array. A PD array is a order block, a old high or low, a breaker, inversion value gap. You have many PD arrays. And let's first talk about the liquidity manipulation. What you want to see for a high probability fair value gap is that before we create the fair value gap, we want or a sweep a high or low, or we reach into a fair value gap and we react from that. So there's already a confirmation that we want to trade off another PD array. Those are the fair value gaps. And if you combine that PD array with the smart money reversal, so fair value gap creation for the liquidity manipulation phase, inducing traders to enter in the wrong direction. So what do I mean by that with the smart money reversal? Smart money reversal is a V-shaped recovery, a sharp turn. There are many different names for the same beast. When we hit a array, we see aggressive sells, aggressive buys, and we go the other way. But what happens, and this is how you can avoid to get faked out and not trade close to a old high or low and old fair value gap, is a fair value gap created before the liquidity manipulation phase. So here there is a fair value gap created. And what usually happens is when you're just bearish, lower highs, lower lows, you want to just continue that. So trade it to the fair value gap to then continue trading lower. But what happens if we trade into a PD array? So say this is an old high or low, old fair value gap. We don't do that. So instead of going lower, we disrespect this fair value gap and create a new fair value gap. And this is the smart money reversal, aggressive sells, aggressive buys. And that's a very powerful way to use fair value gaps. This fair value gap becomes an inversion fair value gap. There's another array. We're going to focus on fair value gaps in this teaching. So the bearish fair value gap is disrespected, and we have a high probability bearish fair value gap right here. So using that smart money reversal is going to make it very high. And now let's see how the smart money reversal actually looks like. So here we have bearish price action, and we trade into a January low, a monthly low right here. And we are just bearish structure. We're respecting bearish arrays. So you ideally want to just continue. But remember what the smart money reversal does is when we hit a higher time frame, important level, a key level, price could reverse. So let's see what price gives us. So where you are expecting this fair value gap to hold, to then just go lower. So price comes here and you expect price just go lower, but we already hit that monthly low. So here you can expect that smart money reversal. So you have aggressive sells, aggressive buys. So you already see this first fair value gap being created, and then price starts just creating more fair value gaps to the upside. Here we have the liquidity manipulation phase. We trade into an old low and then start to reverse. And this V-shaped recovery, this aggressive sells, aggressive buys, is one of the most powerful ways to spot high probability fair value. Now you know how to use that smart money reversal with the high probability fair value gaps, with the liquidity manipulation phase, smart money reversal. It's very important to not only rely on fair value gaps. So pillar 3 focuses on that, combining fair value gaps with other PD arrays. So for example, what I like to use, my favorite combination, is combining an order block with a fair value gap. You can also combine a fair value gap with a breaker. It's called the unicorn model. You can mix and match. And let's look at an example why this is so important. Here we look at a naked chart, and let's go over what you see right here. What I see here is we take an old low right here during the New York session. Then we start displacing higher, leaving a fair value gap. And the current pillar we're focusing on, we want to see overlapping arrays with our fair value gap. So what I see here is an order book like this. We have liquidity sweep, then we have displacement higher, breaking structure with this fair value gap. We also have an order block where we tap into in the London session right here before displacing higher again. And you want to see overlapping arrays with your fair value gap. So here we have a fair value gap. We tap into that together with the order block, and then price starts to go higher again. We also have a breaker here. Just keep it simple. Just focusing on one PD array together with your fair value gap, and order blocks are the most easy. With this, it's very important to know in your fair value gap where there is high resistance liquidity being created and where there's low resistance liquidity being created. Low resistance liquidity is easy to target because that won't hold. High resistance liquidity, that's structure that will hold. So you want high resistance structure to defend your position. And one way to look at this is via inducement. So in this price action, we have a fair value gap, and we already tap into the fair value gap here. So you expect price to just go tap to the value gap and go higher. What happens lots of time is that we sweep that low in the same fair value gap one more time. So you can call this also a turtle soup or inducement, however you want to call it. So we tap into the fair value gap one more time, taking out the buyers who had a stop loss below this low to then make the real move. So ideally you want your stop loss to be below the fair value gap or below a swing low, not below this low, because we can go back to the fair value gap one more time. Bonus points here is if you can combine it with an SMT. So in this liquidity sweep, there's an SMT. If you don't know what SMT is, on my channel DionTrades, there's a full breakdown on how to trade SMTs. It's a break of correlation of two correlated pairs. So Euro US dollar, for example, and GBP US dollar. If one takes the low and one doesn't take the low, you have an SMT on your hands. So inducement with SMT. This is one type of inducement. The other one is when we didn't tap into the fair value gap yet. So it looks like a breakaway gap, but we come there one more time into the value gap to then continue with the move. And this is high resistance structure. When this happens, guys, you can safely put your stop loss below that low because it's already protected low. We already took liquidity with this move. And let's see how this looks like on the charts. And here we're looking at multiple examples of the inducement. So in this piece of price section here, we displace lower, tap to the fair value gap, and then trade lower. So you expect price just keeps going lower and lower. We don't do that. We tap into it one more time right here, creating high resistance structure here to then make the move. Order block, fair value gap, and right here we do exactly the same. So let's zoom in on this piece of price section. We displace lower, leaving a fair value gap, breaking structure, and then we have few taps to the fair value gap, but before the real move we do one more tap. So here are the early sellers getting taken out, one more tap before the real move. Same here, tap to the fair value gap. You think we are breaking down, we're coming back to the piece of price section one more time. These highs are high resistance highs, so you can safely put your stop loss above those highs, and you can keep doing this. So in high resistance structure, you see this all the time. So we tap here one more time right here by this candle, creating also an order block below there as well. Two fair value gaps, tap here, you think we're good, we're going here one more time before going lower. And in the fifth and final pillar, we're going to all of this together and adding market maker models to the mix. A fair value gap that aligns with your higher time per point of interest with a market maker model is the key concept in profitable trading. So how this looks like, we have the smart money reversal from the earlier pillars. So we have that bearish fair value gap where you actually expect price to come back in and then trade lower. But we don't do that because we already trade into a key level. Can mean all fair value gap, can mean all high or low. Bonus points here is if you use this key level on the higher time frame. So ideally, this is a daily, weekly, or monthly high or low or fair value gap. So ideally, let's say this is a weekly fair value gap. This is a 4-hour structure with time frame alignment. This one, so you want 4-hour structure to create the fair value gaps. Aggressive sells, aggressive buys, fair value gaps, fair value gap. And in these fair value gaps is where you want to take your entry. These are the highest probability. And let's see how this looks like on. So in this example, you see all the pillars coming together. What we see here, we have displacement higher. And we already tap into this fair value gap one more time. So we have swing low created here. We still have a higher time drawn liquidity. So price comes back here, sweeps liquidity. This is a weekly candle and then trades higher. So from this weekly level, we want to see on the 4-hour aggressive sells, aggressive buys. We already have inducement here, high resistance low. So let's see how this looks like on the 4-hour. And again, we start with a naked chart. So here is the inducement low, the high resistance low. So we take the low, but before we do that, we have this fair value gap. So we think price just continues lower, fair value gap lower, fair value gap lower. But we don't because we already traded into that weekly level. So it's now potentially time for a smart money reversal. And we get that. Aggressive sells, aggressive buys. And let's see how the annotations look. So here we have that old fair value gap that's disrespected, becoming an inversion fair value gap, aggressive sells into the key level, liquidity sweep, and then displacement higher, breaking structure. We have a fair value gap here, 4-hour, another one right here. See how the inducement happens a lot here inside the fair value gap. We tap into it, swing low, create it. We take it one more time here before going higher. Same here, we take these lows one more time. This all happens into one 4-hour bullish fair value gap. So inside this 4-hour bullish fair value gap, you can drop to the 50-minute and find more entries. If we go higher, we displace again, little breakaway gap here. So we don't come back into this fair value gap, but then we create an order block right here, order block with a fair value gap. We tap into it a few times before going higher again, going to the draws on liquidity. So here you see it happening again. You think we might want to go lower, so we take a swing high. We go lower, but we have a higher time per point of interest. That's all the way up here. So sellers are induced to go into the market, but they get taken out by these candles. See how there's still bullish structure created here, bullish structure, order block right here, and see how the order block, this one, gets tapped into before going higher. All starts from the smart money reversal, the aggressive sells, aggressive buys from the weekly level to a 4-hour structure using time frame alignment. If you enjoyed this video, I'm sure you will enjoy the 2024 and 2025 mentorship here on this channel. And I noticed only 20% of you watching actually subscribe to the channel. So if I can ask you for a small favor, if you like this channel and you like the value you receive here and want to support me, the best and easy way to do this is to hit the subscribe button. And my commitment to you is if you do that, I'll make sure that every new video will be better than the previous one. Thanks for watching, and I'll see you in the next one.